Hi, Jim Cruzan here, and welcome to the second quarter capital market review or halftime report. The information today will really focus on what happened in the second quarter since the end of the first quarter. Before we get into this, just a brief moment to read the disclosure and understand these are my comments and not those comments of Raymond James or any other facility. As I do every quarter, I try to identify a theme, a title, and I think the title we're going to use for this presentation is Smooth Sailing with a question mark. Seems like the economy is growing great, all the data seems fine, yet the market has been somewhat stuck. Up until just recently, it was somewhat flat. If we looked at the end of the quarter, the S&P was up barely, and it changed its lead a number of times during the quarter where we were either up or down a little bit. So we're going to focus a bit on the data and exactly whether this is the beginning of the end or whether we still have a bit more growth to go. We do these because we think the economy matters, and being able to identify the economy can give us a little bit of a jump on what we think will happen next. So what we're going to try to do, as we always do, is dissect a few of the major components. We'll want to look at growth. We'll want to look at jobs and job creation, corporate profits. We'll talk a bit about inflation and also interest rates and the Federal Reserve. We do this in an attempt to answer a couple of questions. Specifically, where are we right now? And more importantly, where are we heading? When we have our investment meetings, which are weekly, we ask ourselves two questions. And we have to have an opinion on these two questions, and hopefully we have to get them right. The first is, where do we think we are in this economic cycle? There's only four places we can be. We're either in a recession, we're in a recovery, we're in a mature market or a slow growing economy, or we're in an aging market or an economic slowdown. Right now, because of a lot of the stimulus we've had this last year, we're still in this mature, slow growth economy. But very soon, it is 10 years in length, we may see ourselves rolling over to a economic slowdown or an aging market. That is not, as of yet, a recession. The other question we have to get right is, what do we think the Federal Reserve is most apt to do next? And clearly, we think they're in a tightening mode and will be for some time. And that certainly has its own implications on economic growth. Today's agenda, we're going to touch on really 6 different areas. We'll talk a bit about the economy. Is it heating up? We're going to talk about recession. When might we see that? And if so, so what? We're going to talk a little bit about yield curve and its inversion. There's been some talk about that in our economic and investment circles, so I thought I would share that with you. And is it something we should worry about or not? We'll talk about the equity markets and what's happening now, and also the international markets. They've been a little bit soft here recently, in part because of tariff talks, and we want to kind of look at that from the standpoint of, is this a problem or just simply a soft spot, and should we make adjustments according to our mix as a result of that? And last but not least, a little bit on tariffs. Just with the extent of tariffs, what kind of an impact can we really expect in terms of our economy? And you might be surprised. All right, well, let's get started. Let's talk about the economy, and let's look at whether or not it is in fact heating up. Maybe the best thing to do is look at the chart on the left. This chart here is actually real GDP growth, and it shows changes in GDP year over year. And as you can see, way on the right-hand side of this, there's a fairly steep upward trending curve. That implies that the economy is in fact getting better. And if you look at the average expansion, it's been about 2.2%. We are now at the point where we're tracking close to 2.7. And actually our year-over-year numbers are 2.8, which is even above trend. So that implies that the economy is in fact improving. We should see year-over-year GDP this year, when the year is finished, at something close to 3.2 or 3.3%. And that growth should continue for better part of the year, maybe continuing into mid-year 2019. Let's now turn to unemployment and wages. a couple of things. The gray line that we see is actually the unemployment rate, and the blue line that you see is wage growth rate. Now, a couple of interesting things is we're beginning to see wage growth starting to move in an upward direction, and it's growing at about 2.7%. Wage growth certainly is still well below trend because the long-term trend is about 4.2. And what's really interesting is we've had very low subpar wage growth for a long time, really going back to the early 80s. And you'll see wage growth really fell off a cliff. I'm looking at that and I'm thinking, why was that? Obviously, it was a huge spike in productivity. And this period of time here was in and around the very first adaptation for desktop computers. And I think that created a huge quantum leap in productivity. And as a result, it quelled wage growth rates for the last 30 plus years. And we can see the unemployment rate has fallen significantly. In fact, it ticked up just a hair with June to 4. Prior to that, it was at about 3.8. I think that's a one data point reversal, and I think it has a lot to do with the fact that it's reflecting a lot of newly minted college grads that have entered the workforce, many of which are still looking for work, and that will purge itself through the system fairly quickly. If the economy continues to grow, we could see the unemployment rate drop to something closer to 3%. If that happens, we may very well see a slowdown in economic activity, and we'll touch on that in a moment. Wage growth more than likely will still continue to track below trend, but obviously this upward trend does have a tendency to be a little bit inflationary. We expect to see a slight increase in inflation, but nothing like the high inflationary times that we've seen before. In fact, we're seeing a slight uptick already. If you look at the headline inflation numbers, we're tracking at about 2.7, and that's about the highest point that we've seen in the last 4 or 5 years, and certainly the highest point that we've seen since probably 2012. And in almost every single case, however, the current inflation numbers, whether you're looking at core or food, headline or PCE, they're all generally well below the 50-year average. Now, that 50-year average also included the 1970s, which was a very inflationary period. The only thing that's trending up above that is energy at 11%. And we think that's a short-term issue, and that will also rewrite itself at some point in time. Core inflation at 2% is still very low. Headline inflation at 2.3%. That is the Federal Reserve's target. Speaking of the Federal Reserve, the economy, as it relates to interest rates, is somewhat like the weather. It will heat up and it will cool down. And what's happening is the economy is beginning to heat up. So the Federal Reserve is starting to raise interest rates. And at some point, this increase in interest rates will in effect start to once again cool the economy down. So it may very well be this rise in interest rates, which down the road becomes the catalyst for a somewhat of a slowdown in the economy. If we look at GDP and we look at kind of the long run target numbers versus where we are today, we're seeing GDP growing at a much higher rate than trend. We're seeing the unemployment rate here much less today than trend. And we're seeing the PCE inflation rate being just slightly above historic trend. If for no other reason, that will imply that the Federal Reserve will probably raise rates another 2 times this year, and they will probably raise rates 3 times or so next year. Now, a lot of that news is not yet reflected in the market, and you can see that by this chart here. What we're seeing at the tail end of this are forward-looking market expectations. This is kind of how the market is pricing things today versus what the Federal Reserve's Open Market Committee meeting notes are suggesting. And you can see the Federal Reserve expects that they're going to ramp up rates pretty significantly over the next several years. And the market thinks that they're somewhat bluffing, that in fact the economy may cool down a bit before that, causing them to dampen their expectations. We will see, but we should see soon some deviation between what the market is expecting and what the Federal Reserve does. As an example, there's a very good chance we'll see 4 rate hikes this year. Early in the year, the market was expecting 3. Chairman Powell has all but said 4 guaranteed. So at this point, the market is now kind of coming up to those Open Market Committee meeting expectations. But more on this later, and we'll certainly have better clarity come the fall. We've had a lot of stimulus, especially fiscal stimulus, the last year or so. And we could see a little bit of a slowdown because we're simply not going to have the same amount of fiscal stimulus. And part of that is simply because the deficit is expected to continue to ramp up, and that's going to put a pall on really layering in a significant amount of additional fiscal stimulus. You know, fiscal stimulus is great. It's like a shot in the arm of adrenaline. It improves things very quickly, but at the same time, it causes deficits to somewhat increase, which will then cause interest rates to increase because the Federal Reserve will have to finance that by borrowing more money, and they will have to make sure that those rates are competitive, and it usually will then cause fiscal policy to change and tax rates to increase somewhat to be able to pay down or pay interest on that outstanding debt. So we certainly have to look at that. And if you look at net deficit or accumulated deficit debt, you can see how the expectation is that also was ramping up and will ramp up quite a bit over the next 10 years. Today, we're somewhat comfortably, our outstanding debt is 76% of GDP. It's going to be a whole lot closer to 100% of GDP here at some point 20 years out, unless we make some structural changes here. And one of those may very well be Social Security. So we'll see what happens. Other than that, there's not a lot that we can do. Let's talk about another reason that the economy may at some point slow down, and that's just simply the lack of workers. If we look at this box here on the left-hand side, and in particular this period of time of the expansion, the recovery that we've had, you can see that the actual number of workers or growth in working age population, there's a slight edge. We had more of those coming from folks that immigrated to the U.S. than actually those born here in the U.S. So that's an issue because we have somewhat of an uncertain immigration policy going forward. Also, GDP, which you'll see here, is just simply a function of 2 variables. One is the growth in workforce or workers and the outcome or productivity of workers. Those 2 things combined is GDP growth. And you can see that productivity kind of peaked before the Great Recession. And lately, the last 10 years or so, productivity has been somewhat compressed. We haven't had a new technology to take productivity to another level. That, coupled with the fact that we're seeing less workers or growth in workforce, less number of workers available, should put a pall on and reduce GDP growth at some point going forward. Most of the GDP growth we've had over this recovery has been a function of knocking down the unemployment rate from 10% down to the 4% or so that we see today. Let's try to answer the second question, which is about recession. When we expect it, and if so, so what? The chart on the left will tell us that this recovery is now actually 109 months in length, and it's the second longest recovery in history. And if we look at the strength of economic recoveries, all those in the past, and including the recovery that we're in presently, what you're going to find is our recovery that we're in today, which is this one down here, you see started in '07, is one of the very weakest long-term recoveries we've ever had. So because of that, we may very well see a recession, may very well start sometime next year. But because we haven't had nearly the economic growth off the bottom of this one, we wouldn't really expect it to be as severe as some of the large recessions we've seen recently, like the dot-com or the financial crisis. It may very well be different and actually more like most of the recessions we've seen in the past, with the exception of those two or so. Another reason for that is if you look at the financial crisis, which is kind of represented with the spike in unemployment here and the recovery since, and you look at prior recessions and the spike that we saw in unemployment, we might see as we go through the next recession, unemployment will increase, but it's more than likely to increase to a level well below the peaks that we saw either in the '82 or the '09 recession. It just seems like this is different. We have a lot less leverage built into the financial system. The question is, does the Federal Reserve have the tools to aggressively counterweight or battle the recession? We will see. From the stock market, we're looking at what bear markets kind of look like. And you'll see the dot-com bubble, which is back in 2000, PEs peaked at about 24 times earnings. So there was a significant amount of fluff or air in the market, and it certainly was let out. Today, PEs are a lot more like 16, which is right on the long-term 25-year trend line. So while the market may seem really expensive, because of the huge improvement in corporate profits, PEs have actually come down quite a bit. So the market isn't nearly as expensive as it would have been had we priced this thing just last fall before the tax cut. And that will also help stem the type of drop that we may see during the next recession. Speaking of recessions and bear markets, this chart goes all the way back to the Great Depression, 1929. And if we look at the chart below, which shows the amount of drop that we had in the market during those recessions, and we excluded the Great Depression and maybe the financial crisis and the dot-com crisis, which were somewhat one-off events caused by liquidity or very high PEs, you would see that to a large degree, many normal recessions see drops in equity values in the 25-30% range, certainly not like the 50% range. And that's important because if we're running a well-diversified, balanced portfolio and we're employing some mindful downside risk tools, then we should be able to manage very well through whatever the next recession may look like. Okay, let's see if we can address the third question, which had to do with the yield curve and this talk about inversion and what it means. First off, an inverted yield curve, and I'll explain that in a second, really is more of a symptom as opposed to a disease. And in many cases, yield curves will invert when economies are heating up and the Federal Reserve is taking action to reduce that. But that said, let's kind of look at a healthy yield curve and then where we are today. So in 2013, 5 years ago, the yield curve kind of looked like this. And you'll see short-term interest rates were a whole lot lower than long-term interest rates. And that was very healthy. Consider it from a banker's point of view. Banks are paying you very little for your deposits, but then they're lending it out at a much, much higher rate, better for them, and that spurs economic activity. There's a lot of money available for development. What's happening today is the Federal Reserve is raising interest rates, and they raise the short-term discount rate, so they push these rates up. So the yield curve today is not nearly as steep as it was. It's flattening out. And at some time, what will happen, it will actually invert a bit, where the 10-year yield may very well be lower than the 3-month or 1-year yield. And that becomes a problem because that slows economic activity. From a banker's point of view, I'm paying depositors a whole lot more money, and yet when I lend it out to people 10 years or longer, I'm making less. That doesn't work. So all of a sudden, money is hard to come by, and development and capital spending tends to slow down. So that's why looking at an inverted yield curve is somewhat important. It tends to dictate some risk of an economic slowdown. Generally, we don't wind up in a recession as soon as this thing flips. It usually takes a year or 18 months beyond. There have been few occasions where an inverted yield curve did not throw us into a recession. It is not the thing that throws us in. As I said, it's more of a symptom. So when could this thing invert? Possibly a year from now. Assume that we have 2 more rate hikes this year and 2 more hikes in the first half of next year. At a full percentage point increase, you will see the short-term rates move from where they are today up to, for example, this 1 year might be pretty close to 3.1, 3.2, and then the 10-year might move up to, call it 3. So we would have an inversion, a very slight inversion. So it's something that we're certainly watching and taking into consideration. But again, if we're not inverting for a year, and we usually don't see a recession until sometime thereafter, we certainly have some time to adjust the portfolios accordingly. The fourth question has to do with equity markets and corporate earnings. And this chart's really kind of interesting. It shows the S&P 500, and it shows year-over-year earnings growth. So look at the amazing earnings growth that we're expecting this year. Earnings are up 27%. And if you look at the components of earnings, the gray box here is margin. That's internally their profitability. The green is revenue growth. Are they selling more stuff? So if you consider this, the green box is, hey, are we selling more stuff? And the gray box is, are we selling more efficiently? Is more of this sale dropping to the bottom line? And you'll see the margin improvement is 16%. A good deal of that is the tax rate cut on corporations. But the amazing thing is this improvement that we've had in revenue. People are selling more stuff. People are buying more stuff. Consumer confidence and corporate executive confidence is very high. That should continue for a while. If I'm interested in something, I'm not going to say I'm concerned, is optically it might look a bit different next year. Now, this quarter, next quarter, we're going to see very similar results. But what happens in 19? In 19, we're not going to have nearly the same margin expansion because we're not going to have another tax cut. We might still have very good revenue growth. So we may go from 27% earnings growth in 2018 to maybe 3 to 7, 3 to 9 next year, and that would look like a shortfall. So it'll be interesting to see how that plays out as well. As far as returns are concerned, here we are in what we believe to be the slow growth environment. And in a slow growth environment, large cap stocks typically perform better than small cap stocks, and growth generally performs better than value. So year to date, we can see growth was up about 7.3% versus value, which was up only about 1.7, or actually was down. So that's a spread of nearly 9%. That's a very large spread. And I mentioned that large cap tends to outperform small cap, but you'll see small cap performed a bit better. I think that has everything to do with the tariff talk. Smaller companies tend to operate domestically. Smaller companies have less worry or risk with export and, in many cases, import. So to a large degree, they have less risk with respect to tariff talk, and as a result, they've gotten a bit of a premium. But this spread between growth and value is really interesting. It's about as wide as it's ever been. And any time in the past when we've seen this type of a wide spread, at some point value will start to take the lead. That's not the case right now. Growth is certainly performing better than value. But should the economy slow up, then all of a sudden we expect value will take a lead over growth. So we're beginning to reduce our overweight in growth in many of our portfolios. We have had and continue to have a somewhat overweighted position in growth over value, and we're beginning to slowly reduce that overweight to at least a neutral position. Question 5 had to do with the international markets. Is this a problem or somewhat of a soft landing? And by problem, what I'm referring to is simply this. If we look last year and we look at all country world index without the US, that's everything outside the US, versus what the US did, you'll see the international markets last year significantly outperformed the US. Not so much year to date. The US outperforming all country world index by a sizable amount. We think this has a lot to do presently with tariff talk, and we believe this tariff talk is somewhat of a negotiation, and at some point we'll have better clarity, and we think the international markets will once again resume their not only upward trend, but the trend of outperforming. And a couple of reasons it makes sense to still stay firm with international is simply the opportunity set. This is the global allocation of equities throughout. And you can see the US is about half the cap weighting of all world equities. So by just concentrating on the US, we miss out on a lot of opportunity. This slide here talks all about diversification from the standpoint of correlation. How closely does US versus international track together? To add diversity, you want things that are somewhat less correlated. In the last couple of years, we've had a pretty sizable decrease in correlation, meaning we've gotten better diversity. Since about 6-7 weeks ago, we had a spike up. Again, we think that has everything to do with the tariff talk, and we think at some point the trend toward better diversity continues. To continue to talk on international, let's look at this heat map. Now the heat map talks about or reports out Purchase Managers Index. In other words, their view on the health of the economy and the likelihood that we'll see additional trade, additional purchases of equipment, etc. Anything above a 50.0 or 50% is positive. Anything below that is contraction. So we begin to see shades of green above 50%, and we begin to see shades of red below 50%. And to a large degree, with rare exception, everything is shaded green or moving toward green and moving away from red or pink. Very healthy. If you look at the US market, which is right here, you'll see we've been green or greenish for a very long time, suggesting that we've had a fair amount of economic activity and growth since the financial crisis. And yet, when we look at a lot of the other countries that are now very much green, you'll see to a large degree they've turned green just recently, as in the last 5 or 6 years. So to that extent, we have many countries that are starting to grow financially, grow economically, and yet they haven't done so over the same duration. So they're not anywhere near where we are in terms of our expansion. So the opportunity set may very well be greater outside the shores of the U.S. Another thing to take a look at is just simply valuations. On the right-hand side, we'll see 25-year historic valuations for securities, and we'll compare this somewhat to the U.S. market. So here we are in the U.S. The gray bar represents the range of valuation that they would have had over that 25-year period. This is low valuation, 10 times earnings, high valuation, 25 times earnings. That was leading into the dot-com bubble. And the purple line is the 25-year average, and the little diamond suggests where we are today. So you'll see, and we saw this on another chart, we're right at average. We're not trading above average. Yet, when we look at developed markets, European markets, Japanese markets, and emerging markets, to a large degree, we're trading in all cases below the 25-year historic average. So that implies there might be better valuation elsewhere. This chart talks about emerging markets and its comparison to developed markets. And if you look at the left-hand side, very clearly you can see growth rates are significantly higher in emerging markets than they've been in developed markets. And to a large degree, that has an awful lot to do with the huge increase in middle class development within the emerging markets. If we look at where emerging markets are today, in particular comparison of middle class currently to where the expectation is in 2030, it's significant. 12% of the population in India is middle class. It'll be 80% in just 12 years. China will be 70%. You're looking at Korea, and you'll see that's sliding back ever so slightly, and the only reason for that is birth rate. But it's really interesting. The middle class drives consumer spending, drives economic growth, drives corporate profit and expansion. So that's a reason that we're interested in emerging markets. Many say that the emerging markets may very well be the best growth vehicle the next 10 years. That said, we've reduced our exposure in a number of our accounts to the emerging markets, just simply because of the weakness that we're seeing today as a result of trade talk. Once that's resolved and we have better clarity, we'll probably step back into emerging markets again. So this slide talks about currency, and in particular, its effect on international markets. Simply put, if we look at the left-hand slide, which shows the US dollar in historical terms relative to foreign currency, when the dollar is strengthening, it hurts international returns. And when the dollar is weakening, it tends to help. So last year, we had a sizable weakness in the dollar, which helped international returns. And now, with the tariff talk, we're seeing a little bit of an uptick here in the US dollar, and as a result, international securities are somewhat weaker. And you can see that here. This slide talks about the return in the local market. That would be the return here in this market as Americans, or the return in Germany as Germans, versus the currency. So last year, 2017, effectively, we had a really strong return here in the US, but because the dollar was falling, we had a kicker. We had an extra return, so the international markets returned better than the US. Today, we're seeing a negative kicker, which is driving the international markets down because the dollar is rising. And again, we feel that that's somewhat short-lived. The last slide I want to share with you, as far as the economy, helps to maybe answer or frame this question about tariff talk. Tariff talk is a big issue, and it's having a lot of volatility, causing a lot of volatility with respect to the markets. But in the big scheme of things, as far as our economy is concerned, all the export trade that we do pales in comparison to all the goods and services that we produce and are consumed here by Americans. In fact, the only data point I want to share with you is exports as a percentage of GDP. And here in the United States, it's 8%. So if we lost all export business, it would affect our GDP by about 8%. that's not that significant. And another way of looking at that, when you compare exports, US versus even our trading partner in Canada or China or Mexico or Korea, it doesn't hurt us nearly as much. It hurts them more than it hurts us. And I'm certain that a lot of this talk is just a negotiation because Trump also understands this relationship. We'll see how it plays out. We're ready to take action if we need to. We'll certainly communicate to you directly if there's a need to take some type of action. But at this time, we're allowing it to play out for the reasons mentioned here. So in conclusion, so far so good. The economy is really smooth sailing. If we didn't have those distractions in terms of tariffs and Russian collusion and other issues, I think the market may very well be higher than it would be presently. But in spite of all that, with all the things that we have to worry about, with all the news flow, the fact that the market is where it is really a testament to the underlying strength that we have presently. As always, we appreciate having the opportunity to work with you. If you know anybody who might like a second opinion, who might like to see what we do, how we do it, we'd love the opportunity to sit and talk to them. We have a very elegant process. We call it our evolutionary wealth process that takes a potential client through a discovery interview, a clarity meeting, mutual commitment, and then plan development. And we'd love the opportunity to share that. As always, we'd be interested in any questions or comments you have. Simply pick up the phone, email us, and we'll be glad to respond to you directly. And also, if it's something that would be of a broader nature, we'll certainly mention that and get that out to everyone. So once again, thank you very much for your time and attention. I hope this was valuable. And we'll see you next quarter with another catch-up on what has happened since this meeting. Thanks so much.